In this video, I'm going to talk about deferred expenses. And deferred expenses are simply advance payment of expenses. So for whatever reason, the company paid for something in advance of actually using that item. So this could be prepaid rent, where they pay in advance for several months of rent, or prepaid insurance, maybe they pay insurance for the whole year, or office supplies technically would fit in this category as well, because they're purchasing the supplies. And under accrual-based accounting, you're learning that when you purchase supplies, you put them on the books as an asset. Well, for this, you would expense those office supplies as you use them up. So that's going to go in this category as well. And I'm going to walk through some examples so that I can show you what I'm talking about. And then we're also going to cover depreciation, which is going to work in a similar way in that you purchase an asset and then you expense depreciation over time as you use that asset. But I'm going to actually cover depreciation in a completely separate video because it's a longer topic, so it's going to take a little longer to go through some examples. Okay, so basically when you pay an expense in advance, you have to think about the definition of an expense versus the definition of an asset. If it's an economic resource or something they're going to use in the future, or something they own, or something that's going to benefit the business in the future, that's closer to meeting the definition of an asset. So when they're prepaying things in advance, they're going to record those things as an asset. And then an expense is more of something you use up, or a cost of operating the business. Usually expenses are things you've already incurred or you're incurring in the current period. So if you're paying rent for the current month, that's rent expense. Whereas if you're paying rent in advance for future months, that's prepaid rent. So that's the difference here. But basically the reason this comes in as an adjustment is you would put these items on the books as an asset if they're prepaid. And then as you use the rental space, as you use the insurance coverage, as you use the office supplies, they're no longer a prepaid item because you've used those things up. So you would need to transfer from the prepaid account over to expense. So I'm going to write that out just to kind of clarify. So you would record the prepaid expense as an asset, and then you would do an adjusting entry to record anything that you've used up, because once you use it up, it's no longer an asset, it's more of meeting the definition of an expense. So you can do these adjustments any time of the year, but you would really look at things at the end of the year. So basically you're recording the prepaid expense as the asset account, and then at the end of the year or end of the month, you would do an adjusting entry to record the expense of what was used up or expired. So let me walk through an example of that. So let's do prepaid insurance. Let's say the company pays $1,000 for insurance coverage for the year. And let's assume this was paid on October 1st. Okay, so what they would do on October 1st is a journal entry for the prepaid insurance. And then they would credit cash for the cash that was paid out. So prepaid insurance is an asset account. I'm going to make a T account over here. I'm not going to make a T account for cash since that's not the focus of this. I just made a T account for prepaid insurance. So this happened on October 1st, and by the time they get to the end of the year, some time has passed and they've used up the insurance coverage from the time period of October 1st through December 31st. So December 31st would come, they would be doing their adjustments. They're going to want to take out the insurance coverage that they've already used up because October through December 31st is no longer prepaid since the time has passed. Now that would be considered insurance expense. So we want to move part of this $1,000 from the prepaid account over to insurance expense. Okay, so what you would do first of all is calculate or look at how many months has gone by since the insurance started, and you would count October since it was the beginning of October, you would count November, and you would count December. So that's 3 months, and it was a 1-year policy. So basically 1/4 of that coverage has been used, or they've received the benefit for 1/4 of that insurance coverage. So you would want to move 1/4 of that $1,000 over to insurance expense. So to do that, you would debit insurance expense, and 1/4 of $1,000 is $250. So you would debit insurance expense for $250, and then you want to subtract from prepaid. So your credit would be to prepaid insurance for $250. So this would be your adjusting entry. And I'm sorry, my writing is a little scratchy. It's kind of hard to write down low on the board. Okay, so I'm going to put that in the T account. So we've got the $250 that was deducted from prepaid insurance. So that went on the credit side. And now if you take the difference between the $1,000 debit, the $250 credit, that leaves you $750 as a debit balance in prepaid insurance. So that $750 represents the fact that they still have January through September of the following year. They still have 9 months of insurance coverage that's still prepaid. So that would sit there until they made more entries as that insurance expired. And then you would have insurance expense. Insurance expense would have $250 in it, and that would represent the October through December period that was used up and would be considered an expense. So that's basically how it would work. All right, I'm gonna erase this and do a supplies example, an office supplies example. Okay, now I'm gonna do a supplies example. The supplies example is gonna work like the prepaid insurance example. The original purchase of the supplies would go in an asset account. So let's say on December 15th, they purchased $700 of supplies. You would debit supplies, credit cash for $700. And then you would have a T account with supplies with $700 on the debit side. And then at year end, when they do their adjusting entries, they would look at how much they have left over in the supplies cabinet. So let's say on December 31st, they counted $200 of supplies remaining in the supply cabinet. So if they have $200 of supplies on hand and they have 700 in the account, that means they've used up $500 worth of supplies. So 700 minus 200 equals 500 that they've used up. So it doesn't make sense to keep that $500 in the supplies account. You would want to move that to supplies expense. So your adjusting entry on December 31st would be to move $500 from supplies to supplies expense. Okay, so to do that, you would debit supplies expense and credit supplies for 500. Because remember, an asset account, which would be supplies, I'm going to write that up here. Supplies is an asset account. An asset account is a resource. Well, 500 of those supplies are no longer a resource if they were used up, so we moved those to supplies expense. So we've got a debit to supplies expense here and a credit to supplies. And what that does is it leaves a $200 balance in supplies, which matches what they have on hand. And then we've got a balance of 500 in supplies expense, which represents something they used up to help them operate their business, which is more of the definition of expense, a cost to operate their business. And that's it. Hopefully this was helpful. If you have any questions, feel free to comment below, and thank you for watching.